Good Monday morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And the good times may be over. Goldman Sachs is out with the warning that the S&P 500 is not likely to sustain their performance of the past decade.
Plus, Boeing union workers hammer out a tentative agreement with the plane maker ahead of earnings. The vote not until Wednesday.
And we'll take a look at surge and activist activity as Starboard reportedly takes a stake in Kenview. All of that and more coming up, but let's take a look at markets 30 minutes until the bells ring. A little bit lower pre-market, but remember the S&P 500, the NASDAQ 100 closed out on 6 weeks straight of gains last week. So taking a little bit of a breather this morning, down a touch on the S&P, down a little bit more on the NASDAQ 100. All the while, that sell-off in the bond market reigniting, Matt. You can see the 10-year yield higher by about 5 basis points, now at 4.13.
All right, a couple of calls out today. Goldman Sachs says people are going to start buying other things than stocks. And you can see here from this chart, corporate spreads are at tights that we've only seen a few times over the past couple of decades. Meanwhile, Matthew Hornbach at Morgan Stanley says the bond market treasuries are well positioned to deal with a red sweep in November.
Stock and bond markets both dealing with valuation issues, Matt. Let's take a look at some stocks to watch under the hood for now. Boeing, as you were talking about, 3.5% higher. The plane maker reached a tentative deal with the union, and the agreement raises pay by 35% over 4 years. Of course, that vote, though, is on Wednesday. We'll talk more about it. Also watching Spirit, just soaring, 36% pre-market. The U.S. National Bank Association agreed to extend a deadline for the carrier to potentially refinance 2025 bonds. We'll talk about that as well. And Disney names Morgan Stanley Executive Chairman James Gorman as chairman of its board, effective January 2nd. The reason it matters, Disney says it will announce a new CEO in 2026, Matt.
All right, we have a couple of really big calls out driving the market this morning, or at least driving discussion around the market. Goldman Sachs' David Kostin saying that after 13% annualized returns in the past 10 years, we're only going to see 3% annualized returns in the next 10 years from stocks, which could at some point even be lower than inflation. Really
incredibly bearish if you take a look at the rest of the sell side community. It's interesting. The report is over 30 pages long. I'm working my way through all of it. I don't see a recession call in here. There's no necessarily specific catalyst here. And I mean, 3% annualized over the past 10 years. When is the last time we saw that?
Well, consider the reasons why also. And to your point here, no real catalyst, more like a slow bleed. He puts a 72% probability of it trailing bonds and almost a third of a probability here that it doesn't even break inflation of 2.2% break-even inflation through 2034. So long-term call here we're looking at.
All right, let's get to Moneta Chief Investment Officer Aoifinn Devit. She joins us to talk about this and a number of other issues after we hit, Aoifinn, a 47th record high for stocks on Friday. I mean, the gains are really outpacing strategists' forecasts. And is that part of this call, you think, David Kostin and Goldman Sachs worried that we're just pulling returns forward from the next decade?
That's exactly my take on this particular report, and most of it relates to technology. We've been speaking about that tremendous concentration in equity markets and how so much of that related to whether it's the top 7, top 5, and how little related to the remaining hundreds of stocks that were really not making much headway. If we now return to that being the norm, that would very much translate into his forecast. I think it is a little bearish in terms of where I see the future in terms of I don't think everything has been priced into the tech stocks yet. There's quite a bit to play for there. And remember, those stocks that were trailing, I don't think that equally, I think that's been overlooked for some time. So there's probably a little bit of pent up demand in that. So I wouldn't be completely as bearish as that, but I do think it's exactly as you said, it's pulling forward.
So a bit bearish to your read. Let's sit on this call a little bit longer because I do think it's interesting that David Kostin, he actually raised his year-end target on October 4th, and his target over the next 12 months for the S&P 500 is 6,300. That's about an 11% gain from here. So his idea is that we're going to have a good next 12 months and then maybe, of course, like Sonali said, a slow bleed here. When you think about, of course, the trajectory that this market could take, does that sound realistic to you?
does, but then again, we have to remember we have a pivotal electoral event coming up in a few weeks, and that could well have quite a bifurcated outcome. And we've been reading about the various hedges on either side of the potential outcome, and the fact that it could be, whereas it could generally be good for all stocks in that the economy is in robust and rude health, and we have seen that there is pent-up demand on the sidelines, and any wobble in markets doesn't last very long. However, the outcome could look quite different. We could have different outcomes for financials. Certainly, most earnings could do well if the tax situation changes, but equally some of the renewable energy stocks, some of the stocks more akin to more of the Biden economics, for example, or relating to the Inflation Reduction Act, they could come under pressure. So quite a bit of bifurcation possible. Overall, as long as employment numbers stay strong and the consumer buoyancy remains intact, I do see an ongoing strong bid for equities at the moment.
It's interesting at the moment and over the next few months are really easy to latch onto, particularly given the election. But I think one issue behind this long-term thinking here, if you think that the S&P 500 is not going to deliver you as much, why invest at these levels, Aoifinn?
It's a question of better relative to what, in the sense that your colleague earlier mentioned that people are going to start looking other than stocks. They actually have been looking at places other than stocks for some time. We saw quite a bit of demand for cash, for bonds. This was all while the bonds were quite interesting. Stocks are always there, though, as the engine of growth. And the reason that we see this piling in as soon as there's some kind of a correction is because there really is no other way to get these levels of growth into the portfolio. So quite a bit of demand there for stocks, but where else would they go? We've seen real assets really pick up, alternatives, the steady state income, which you talked about this, the spreads being very tight on bonds, corporate bonds. Because spreads are that tight and we see the base rate coming down, we don't see that being as meaningful because inflation will still be there, albeit much reduced, eroding those returns. So we do need to stick with stocks. We need to have diversified exposure in stocks and also look at some of those alternatives.
Does it have to be diversified? Carson Block, you know, he's famous for his shorts, but was saying in terms of the average investor, close your eyes and buy the Mag 7 stocks.
Yeah, that would, I would say, quite a difficult thing to argue for the average private wealth client. We'd like them to be diversified. We like them to be long-term, that kind of volatility. And we forget sometimes just how much stock volatility these Mag 7 have shown. We've seen 10% falls in one day. It definitely takes a strong stomach. We prefer to see a steady state.
Yeah, but Aoifinn, imagine if they did it 10 years ago or 40. I was just looking at a Data Trek note this morning.
That guy is good.
Which was quoting another paper. I think the guy was Henrik Bessembinder, which is a strange name, and that's why I remember a paper from 2023 where he said literally all of the positive stock market returns from 1990 to 2020 are down to 2.4% of the stocks. So it's basically technology innovation that drives all of the expansion of the market.
This is in the game of shoulda, woulda, coulda, which we try not to play too much because what we always know is buying into markets is one thing to get that timing right. To exit at the right time, there's another question of timing. We don't believe that we have that skill set to do that repeatedly on and over again. So we still prefer the diversified approach, recognizing that some themes, though, can be played. We've seen a lot of interest in AI-focused funds, themes focused around digital assets, and much of some of the picks and shovels, the infrastructure behind this. So that doesn't say we can't play themes. We just don't want that to be the only way we play equities.
All right, yeah, it's easy to be the CIO of Hindsight Capital, but you're the CIO of Moneta. So let's talk a little bit more about big tech, because you think about what happened last week. Of course, ASML really sending worries throughout the sector and throughout the market about AI demand. And as we think about the next year and the next 10 years, to be frank, I mean, where do you think we are on the AI investing hype versus reality cycle?
It's interesting. We're starting to have some reckoning right now. We've seen that in just some of the latest stats we've seen coming out of the chip makers, that there is a sense that has some of this, we talked about demand being brought forward. Has that been brought forward? We don't know yet where the demand will settle when it comes to AI. And there's just a lot to play for. We don't know the use cases and the implication of much of this so far. So I'd say there is still a tremendous amount of hype, and that will continue because we know that's where corporate spending is likely to go. But in terms of who the ultimate winners and losers are going to be, it is too early to tell that right now. So we'd say there's going to be more volatility, as I mentioned, in these stocks as the momentum moves around.
You think about what might come to market, not only the existing supply of stocks you could invest in that bet on AI, but also the ones that might be around the corner. You look at what's in the private markets, right? You think about the report over the weekend of Perplexity. AI could triple its valuation here in private markets. Is there a frustration at all from public market investors that perhaps the best gains are still to be had outside of the stock market? By the time they get to the stock market, how much can they grow from there?
I wouldn't say I'm experiencing that kind of frustration. I do see this point, and I think this is only underscoring just the abundance of opportunity here. Most individual investors do not have access to the venture funds that are getting exposure to this private side of the market. We do have increasing accessibility and better vehicles, but that really is out of bounds at the moment. There's a little bit of FOMO relating to that, but I would say most are more than satisfied with the results they've seen in the public markets. They don't need to necessarily get a piece of every pie. But it is important to watch that, because we are looking very much at how that first mover advantage can get eroded, and looking at the private market and where gains are being made there. That's where the erosion may factor in. The recent OpenAI fundraise, clearly that did give some opportunities to individual investors to get in a piece of the action if there was a co-investment opportunity being offered. So there are certainly some opportunities, but I'd say public markets are a safer place to stay, given the variability of the outcome for some of these operators.
All right, Aoifinn, got to leave it there. Really appreciate you kicking off the week with us. That is Moneta Chief Investment Officer Aoifinn Devit. And guys, just to marinate again in this cost and call a little bit longer, that basically are going to get 3% nominal returns over the next 10 years. To me, this is really a call for cash, because again, he's not necessarily predicting a recession here. Yields are going to be high enough for bonds to compete. That doesn't imply that the Fed is going to cut rates back to zero. And in that environment, cash looks pretty good. You know,
something I'm wondering about, he makes that case for bonds as well. And it's been such an ugly trade for bond investors. Let's be honest. You have a call from T. Rowe saying that the 10-year yield is going to go to 5%.
Yeah.
If you believe that.
Yeah, that's an outlier. It's important to point out that that is an outlier call from T. Rowe Price.
That's
right?
fair enough. But what if we get
as
there?
I was saying, Morgan Stanley today coming out and saying, Matthew Hornbach there saying that bonds are well positioned to deal with even a red sweep. So even if Trump wins and the Republicans take the Congress and the Senate, he still thinks we're going to do better than we did in 2016 when the yields rose 50 basis points in 6 months.
Well, we'll have to see. We know that the bond market really has been the epicenter of volatility, even relative to the stock market. And speaking of the stock market, let's take a quick check on futures. Lower today after 6 straight weeks of gains on the S&P 500, on the NASDAQ 100. You train your eyes on the small caps. The Russell 2000 currently are outperformer, but not by much, and still down about 0.1%. Meanwhile, let's take a look under the hood now. Take a look at what stocks are moving with Abigail Doolittle.
One stock dragging on the future, specifically the S&P 500 and the NASDAQ 100. Tesla, after gaining more than 1% last week, giving those gains back right now, down about 1.4%. Lots of chatter are out there on robo-taxi and what its outcome could be, both positive and negative. And plus, Tesla does report on Wednesday, so shares a little bit lower ahead of that event. We have the airlines, the last time I looked, also lower, broadly lower. There is some news on Southwest Airlines that Southwest Airlines and Elliott are going to try to work together as opposed to being any fierce proxy battle. Oil higher by about 2% or so. That could certainly be a macro drag. And then finally, to the upside, Boeing, it is trading higher, up 3.6%. They, of course, have reached tentative deal with their union, which starts with a 35% pay hike. Investors relieved. And Sonali, very importantly, this is in some ways one of new CEO Kelly Ortberg's his first moves. They report this week. We'll be getting more of a flavor then.
Wednesday, certainly a big day for Boeing. Abby, thank you so very much. And coming up, we're going to bring you more on Boeing, what to expect from that vote on Wednesday, and earnings, of course, as well. This is Bloomberg.
Let's get out of high interest and look at what's making headlines around the world. Israeli Prime Minister Benjamin Netanyahu met with top aides over the weekend to discuss retaliation against Iran. This comes after a Hezbollah drone penetrated Israel's air defenses on Saturday and exploded next to Netanyahu's private residence. The U.S. is also investigating a leak of classified documents assessing Israel's plans to attack Iran, according to reports. More efforts to stimulate the Chinese economy. The country's banks cut benchmark lending rates. It's the latest move in a series of measures to revive growth and halt the slump in the housing market. The 25 basis point cuts were bigger than the 20 points expected by economists surveyed by Bloomberg. And Elon Musk's super PAC is pledging to give away $1 million a day until the election to someone who signs a petition calling for free speech and the right to bear arms. In a post on X, Musk said his group will pick a random registered voter in swing states to win the prize through November 5th. Katie?
All right, here's a stock that we're watching. BOEING and its biggest union workers have hammered out an accord that includes a wage increase of 35% over 4 years. It's tentative now. A ratification vote is set for this Wednesday, the same day as the company's earnings. Let's, of course, bring in now Benedict Campbell, our global editorial leader in aviation, for the details and break this down for us. Of course, we're approaching Kelly Ortberg's first earnings report as CEO, and this is a tough time. What does this mean for the different interlocking issues that BOEING has?
Yeah, so Wednesday suddenly turned into a very busy day for everyone involved. Kelly Ortberg will come out with the earnings. That's first. They come out early before the market opens in the US. And then sort of throughout the day, the voting starts by the workers in the Seattle area, which means essentially Ortberg will release the numbers with kind of one arm tied behind his back because he won't know what the result is. And that's really the one big outcome that everyone is looking at. And so it'll be in the evening in Seattle by the time that we find out whether indeed workers agree with his latest proposal. As you said, it's tentative, or whether, again, they turn it down and the strike continues and we go back to square one. Sort of the anecdotal evidence, if you look on some of the Reddit forums and if you hear some of the work of voices, it seems there's broader agreement to go along with this. They have to get 50% plus one to get this over the hump. So there seems to be a little bit more optimism out there. And certainly if you look at the market and the market reaction, there's a lot of investor optimism that this is the offer that gets them over that line.
The other thing that's underneath the surface here is the fact that they might seek a mega capital raise as well. What does all of this uncertainty mean for their ability to court investors?
So the investor side is obviously looking at this very closely. We saw from the rating agencies that they are considering cutting BOEING's rating to junk. They're just one level above the junk rating at the moment. BOEING went to investors over the last couple of weeks and came out with a sort of tentative plan last week. They filed to register for a possible capital increase to the tune of something like $25 billion in stock and equity. So it wouldn't all be equity. But that's sort of the size that we're talking about to right this company. They would do that over the next 3 years. And the fact that they got that registered means that they've won themselves a little bit of breathing room here, a bit of breathing space to get these next steps into shape. That includes the strike. That includes getting production back up. Because one thing that the strike has done, it's really disrupted the production. And that's the first thing I'll need to get back up.
Benny, we thank you so very much for your reporting. That is Bloomberg's Benedict Campbell. Stick with us. We're going to talk about the markets and the shorts behind it. Not looking so good these days. Stick with us. This is Bloomberg.
There's a debate as to what really drives when you talk about the U.S. market, especially the S&P 500 or the Mag 7. I'm in the camp that, although I don't have the facility with math to really try to prove this out, but I'm in the camp that believes that what drives that index are flows. And so at the end of every month, U.S. workers, a lot of them, their paychecks go into their 401ks, which are retirement funds, and there's a robo bid for the stock. You reduce the effective supply of stock because you're taking out the active owners of stocks that will decide, hey, at this price I'm a seller, at a lower price I'm a buyer, and you're replacing that with a holder that will never sell unless and until it has outflows because people are drawing down their retirement accounts. According to that view, as long as the labor market is reasonably strong in the US, which it is, you're not going to see outflows. You're just going to continue to see inflows, especially in those, in the most heavily weighted names in the S&P 500.
And that, of course, was Carson Block of Muddy Waters making some really interesting points. And what an embarrassment of riches we have on this Monday, because you have, of course, David Kostin on one side saying the next 10 years, basically a lost decade. Then you have Carson Block saying, don't worry about it. You have all of these 401ks just passively buying your big tech stocks. Why worry? Why not just invest alongside them?
It's certainly the BlackRock way of thinking. You have supply that comes down in the market in terms of the number of publicly traded stocks, but you have people still investing in the market, and therefore those stocks go up. Of course, since the 90s, we have half the amount of publicly traded firms in the market than we do now. But you have to wonder, did Carson Block kind of top tick here?
In what way?
He wants to invest in the Mag 7 now?
Oh, I see. That's a good point. I mean, this is the debate, right? I mean, the debate is, have these incredible gains that we've seen, 13% annualized over the past 10 years, pulled forward some of the gains that we would have seen over the next 10 years.
I mean, his point, though, is you have all of these passive buyers. You think about 51% of all assets in mutual funds, in ETFs, they're kind of price-insensitive buyers. They're just investing in these indexes. So a tug of war.
And he says, hold your nose and buy the Mag 7. We're going to talk to Eric Johnston a little bit later from Cantor Fitzgerald.
Certainly are.
He may favor the smaller cap stocks.
He certainly does.
And we're very much looking forward to that. And we're going to talk to Matt Gibson from Goldman Sachs. So a lot coming up on this show, including Marianne Bartels. Next, this is Bloomberg. All right, we are just moments away from the start of cash trading to kick off this week. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures are down a little bit, but of course, we hit another record high on the S&P on Friday. 6 weeks in a row of gains for stocks. We're up more than 23% year to date, so we're doing very well in this stock market. You can hear the opening bell ringing. 3M. Minnesota Mining and Materials ringing it down the New York Stock Exchange over the NASDAQ market site. You have this CEO of Retail Opportunity Investment Corp. It's a REIT there, along with, I guess, a ton of friends and family, unless that little kid works there. So we could see a little bit of a loss today. Obviously, after such a big run, you want to take some profits. But we've had KD Greifeld 6 weeks in a row of gains and just record after record high, outpacing strategist estimates.
Yeah, best start to a year since, I believe, 1997. Like you said, up over 23% on the S&P 500. It makes sense that maybe we're taking a little bit of a breather, especially when you consider all of the earnings that are coming in the next 3 weeks. The S&P 500 currently lower by about 0.1%. That's pretty much unchanged. The NASDAQ 100 a little bit more direction, down about 0.2% on your big tech benchmark. And then you take a look at the small caps, not doing too much. Currently, I'm going to call it unchanged. You look under the hood, though, and we do have some action, and we go to Boeing for that. Shares higher after the plane maker reached a tentative deal with the union. Now, that agreement raises pay by 35% over 4 years. They vote on that on Wednesday, the same day that Boeing reports earnings. So mark your calendars. Shares currently up about 3%, Sonali.
Also watching Spirit Airlines. A lot going on in the air world today. Surging more than 37% this morning. U.S. National Bank Association agreed to extend a deadline for the carrier to refinance its bonds for 2025. And of course, you can see the stock investors like it. Shares actually gaining almost 40% now, Matt.
And we're seeing a ton of volume for shares of Oklo. It's a developer of advanced nuclear systems backed by Sam Altman. Share prices have soared more than 100% in the past week because it's like peanut butter and chocolate, right? You get nuclear and AI. Those are like this year's themes and this decade's theme. Bloomberg's Abigail Doolittle is here to break down Wall Street's increasing interest in nuclear energy. Abby?
It certainly is increasing. Take a look at the shares of Oklo over the last week or so, including last week, up more than 100%, 113%. And it's a new flavor of AI because, of course, the driver for the demand for nuclear power, electricity, has to do with AI. and the data center. So let's take a look at these shares over the longer period of time here, or actually take a look at solar versus the nuclear ETF. The nuclear ETF up 27% over the last 6 months or so. Solar, on the other hand, down about 7.4%. So investors assessing the idea that nuclear is better suited. In fact, if we take a look at the top stocks on the S&P 500, because in terms of this hot trend for nuclear, we of course have heard about the deal with Microsoft and Google, and then last week, I think it was last week or it was the week before, Amazon and Ken Griffin signing a $500 million deal. These are the top stocks on the S&P 500. Vistra, a utility, Constellation Energy, a utility, and then NVIDIA, of course, AI, and then Palantir Data AI. So these are the top stocks. The driver for the energy, and then the energy themselves, Vistra, not so bad, up 241% right now, Katie, year to date.
All right, just delicious. Abigail Doolittle, thank you
amazing.
so much. It is amazing.
Have we called the CEO Vistra?
Yeah, over and over again. The CEO of Vistra, please come on with us. But at least for right now, we have a great conversation. Let's talk to Sanctuary Wealth Chief Investment Strategist Marianne Bartels. And Marianne, we've only been on the air for 34 minutes but all we've been talking about is David Kostin's call over at Goldman, basically calling for a lost decade for the S&P 500. He thinks annualized gains will only be about 3% over the next 10 years. Marianne, I'm curious where you fall.
Well, basically my entire career, which spans 40 years, I pretty much have heard that the next decade was not going to be as good as we currently are. When I see forecasts like this, it makes me more bullish. I love having a bearish tone when we're hitting record all-time highs. It means that we can continue to go up.
How far up, and where do you find those places that keep on driving the index higher if you believe that you could still be bullish at these levels?
So I really am a believer that the leadership of this market remains tech and tech related. We're in a secular bull market, and secular bull markets can last for 15 to 20 years. My best educated guess is that we're going to be in a secular bull market to the end of the decade, driven by technology and tech-related companies. And so in the beginning of the year, we were very bullish, and my high-end target was 5,800. But also near the beginning of the year, we introduced a longer-term target of 6,000 to 7,000. And we've had to revise that by year end. We could even hit my longer term target of 6,000. But I still see 7,000 as a very achievable target over the next 12, 16, 18 months for the market.
What is that based on beyond technicals? Are you looking at earnings performance as we see, the S&P 493 kind of broaden out? I think they're expected to show earnings growth of 12 to 16% over the next 5 quarters. The Mag 7, although the earnings growth is going to slow down, still expected to earn 17 to 20% or grow earnings 17 to 20% over the next 5 quarters. How do you see the march to 7,000 being driven, Marianne?
I think that's a really important question. Is this just my father used to use this phrase called air pudding and wind sauce? Is there really nothing to this? Or is there substance to this rally? And I believe there is substance to this rally. We're in earnings season right now. It's very early, but we're seeing companies beat on expectations. And we're seeing what has been the leadership of the market, which really tech and tech related, really coming in with the earnings. And one of the things I learned years ago is when earnings are scarce, it's driven by a growth cycle. You don't get a value cycle until you have an abundance of earnings. We don't have an abundance of earnings. We do have earnings. I would argue that this remains growth. And what I've been saying is that I think we're going into a super cycle or super mega cycle for growth being led by technology. So I do see it fundamentally sound with earnings. And, if you had said to me, even, 3-5 years ago that the Fed would cut 50 basis points with economy growing at 3%, inflation falling, and you're at basically full employment, that's not what my forecast would have been. And here we are with the Fed trying to recalibrate and get to neutral. I think that keeps the economy strong. The other surprise is we have oil falling. Oil hasn't spiked up with all the geopolitical tensions. That puts more money in the pocket of corporates and also the consumer. The other thing that many people don't realize is when you're in a secular bull market, PE multiples expand. So I do think you get a combination of PE multiple expansion with earnings.
Expanding further than where we are now? I mean, aren't we looking at 22 times forward earnings?
So this is where I really differ from the markets. When I looked at the secular bull market from the 1980s to the peak of 2000, what was extraordinary is that you actually traded in a band that led to record all-time high PE ratios. I think we're repeating something very similar to what we saw from 95 to 99. There we had the invention of, computers and the internet. Here we have AI. I think this is going to allow us over time to expand PE multiples, and I would not be surprised by the end of the secular bull market that we reach actual record PEs. Not there yet, but I do see room for multiple expansion, especially in a lower interest rate environment.
Well, let's talk about the rest of the index, and let's talk actually about small caps. Let's go to the Russell 2000, for example, because we're speaking to Eric Johnston in the 10 a.m. hour. He, for example, is very bullish on small caps, and it's been a real hot and cold rally, and you bring up, of course, lower interest rates. Lower interest rates would theoretically benefit those small caps, but how are you feeling about those tiers of the market?
Well, in my opinion, small caps are in a secular bear market, the opposite of large cap or mega cap. And again, these cycles can last 15 to 20 years. Now, this doesn't mean that small cap can't go up. I do believe that they can rally, but I don't think they're going to beat the S&P or NASDAQ. In fact, if there was an index that I really wanted to focus on, if my thesis is correct, is the NASDAQ will be the best performing index.
Marianne, we thank you so much for your time today. Of course, that is Sanctuary Wealth Chief Investment Strategist Marianne Bartels. We're going to bring you now some movers on our radar, of course, after the market opens. Some things moving hot. Kenvue shares surging after activist investor Starboard built a stake in the company. You're watching Kenvue up about 6% now. And remember, activism hot in the market. We're going to talk about more about that in a minute here. But also, we're taking a share, Lumen shares being higher on an AI partnership with Meta. Lumen Technologies now up about 15.3% as the market opens. And of course, we know that this has been an interesting stock. We've had the CEO on this program before, an up and down kind of stock. But seriously, now year to date, up 323%, guys. So a lot of fuel to that fire. But we'll talk more about that AI trade later in this show. Now, coming up, winter is coming, but Canada Goose may be dropping out fashion before then. Top Calls is next. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's take a check on stocks. About 13 minutes into the U.S. trading day, you can see a bit lower, a bit soggy when it comes to the start of this trading week. The S&P 500 off by about 0.3%. Same story if you take a look at the NASDAQ 100. And remember when small caps were winning? They aren't anymore. The Russell 2000 currently off by about 0.3%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, UPS gets a downgrade over at Barclays. Analysts at the bank see near-term earnings risks due to weakness in freight. They're also seeing some longer-term pressures thanks to volume loss and competition. Next up, we have Gilead upgraded to outperform at Leerink. Analysts say that Gilead has a chance to reverse negative sentiment around its oncology franchise after some promising readouts for developing products. And finally, Goldman cuts Canada Goose to a sell. Goldman sees the Canadian company lagging its peers in the sector as the brand momentum normalizes, Matt.
All right. Thank you very much for that. Canada Goose, are you a Canada Goose wearer?
Sure I am. I really get confused whether I should be buying Canada Goose or Montclair. They're kind of the same thing, aren't they?
Montclair seems too shiny to me. Do you not think?
I'm more of I like the Canadian wear.
By the way, there's a mobile phone.
I've been told to move on.
Someone's phone is in the ceiling here and continues to ring. I don't know.
Anyways, we're going to work through that.
Yeah, let's Sonali is moving me on. The team at S3 put together their latest short signals. Lam Research leading with a 51% jump in interest, but major names like Boeing and AMD made the top 5. Here with more is Bloomberg's Bailey Lipschultz. Bailey. so great to have you on
Is
the
that
program.
your phone, Bailey?
I wish
What's
it was.
going
No,
on?
I actually, my first question was like, who's in the ceiling?
I want
Yeah.
to climb up the wall and go get it. But
In
anyway.
any case, we pay very close attention to S3 short data. It often tells us a great story. What are you hearing this week?
When you look at the report that they put out, basically kind of digging through some of the companies that saw notable jumps in short interest over the last week that are reporting earnings in the near term. So really this entire report lays out the fact that when you typically see a jump in short interest, that can correlate to a decline in the share price. So when you mentioned it, we're looking at stocks like Boeing, AMD, also in the the insurance space, Allstate and Everest Group. One thing to keep in mind, though, all of these companies are reporting in the near term, but two of them are in the chip space. This is so funny, I can't even focus.
For the viewers, of course, the phone sound is back.
Yeah.
That's what we keep referencing.
But so the chip space, obviously under pressure after the ASML results, as well as it relates to insurance. When you have two hurricanes,
Right.
there's so much uncertainty around that. So that could be it. But the thing you have to keep in mind at the end of the day, still small jumps. So Lam Research, only 2.6% of shares outstanding are sold short. So while it is a large jump week over week, that could just be one person hedging a bet or putting a kind of bearish bet ahead of earnings.
You know, maybe it's background music. Maybe it's not a phone.
Yeah.
Maybe it's just someone introducing some
It's
light
all in
music.
our head.
Some elevator music. But anyway, so Bailey, it's interesting, of course, to see what short sellers are targeting ahead of earnings. But when it comes to the market for short sellers, I mean, this has been an absolutely brutal market. It feels like companies don't really die anymore.
No, and it's tough, Katie, because of so much of index investing really taking over the world. So maybe you're bearish on a company like we've seen a number of times in the crypto space, and you're willing to wage an activist campaign against it. But if investors are buying it simply because it's in the Russell 2000 or it's in a different ETF, then it's kind of an uphill battle because a lot of investors aren't actually paying attention to the actual fundamentals on a lot of these
That's
companies.
like what Carson Block was saying about that passive bid.
You know, even though he says that he could have just been levered long Mag 7, let's pull up some of his wagers because BXMT, this is the Blackstone Real Estate Trust, has actually been down about 10%. He called that it would cut its dividend. It indeed cut its dividend faster than he expected. It's down 11%, but the wager has kind of plateaued, hasn't it? Also going to pull up Aoifinn as well. This is another company that has very much, and both companies, by the way, have fought back against his allegations, but the Aoifinn stock has also been down about 7% this year. It's not like you can't make money off of shorting, Bailey, is it?
No, not at all. But I think the big question and the big unknown is you can be right and in the long term, but when you're taking on a short bet, you're paying fees to keep on that bet. You're taking on kind of unlimited risk if the stock rips, which we saw with GameStop. So there's kind of, you're betting against the market, you're betting against companies, but there are underlying costs that aren't typically at play if you're just buying Apple or buying any other name in the Mag 7.
To be fair, he said he could have had leveraged longs on those stocks and still been in the same place financially.
Yeah,
so he
true,
wasn't
right.
saying that he was unsuccessful with his shorts. He's
Right.
just saying, and they cause a lot of agita. There was, I think the technical term was BS.
He could have slept easier at
Yes.
night had he just, levered long on the Mag 7. But there's the market conditions for shorting. There's also sort of the reputational risk. There's this overhang of regulation, for example. You think about short sellers being looked at by the SEC, for example, in terms of things that would keep you up at night. I have to imagine that's one.
Yeah, and I talked to a lot of these short activists and kind of digging through some of their theses on individual names, on individual trends. We saw a number of activists going after companies that have benefited at least their stock prices from the AI trend. And the big uncertainty is you look at a company like Lumen Technologies. That was a Kerastale short report from just a few weeks ago, about a month and a half ago. Well, that stock's back up. So whether or not that was a short-term immediate play where you short the company and then cover, which we've seen is kind of the basis of the SEC investigation, or actually bet against a company and hold on to it for the long run. Obviously, when we think about unsuccessful campaigns, think of back to Herbalife when you go Bill Ackman versus Carl Icahn.
I just want to point something out. We continue to reference this Carson Block interview with Haslinda Amin had earlier on Bloomberg Television. You can watch that by going to Bloomberg.com. And I also wanted to quickly ask, you said short activist. Is that a new phrase, or did you just...
Well, activist short sellers. Well, that's the thing.
Okay.
You can bet against a company and be short, but if you're coming out with these 40-page, 300-page
that's what
reports,
makes
that's
you
the
an activist.
activist.
Pushing
You're
for
actually
change.
pushing back
Okay,
against
okay.
it. Yeah.
Just flip the words.
Well, guys, we got to leave it there. Of course, now a lot of these guys throwing in the towel, going long instead. Bailey, we thank you so much. That is Bailey Lipschultz of Bloomberg News. And coming up, we're going to talk about another form of activism. Kenvue shares jumping after activist Starboard, traditional way activists, announced a large stake in the maker of Tylenol. We're going to take a look at increased activist activity next in today's Wall Street Beat. This is Bloomberg.
By our estimate, there's 1 in 4 companies in the S&P 500 has an activist investor in the top 20 shareholder registry. So you can imagine there's a lot of private engagement across that. But what's really changed is not just the activists, but it's the broader investor mindset.
That was Kiran Murthy, Consello Financial's head of shareholder advisory, and it gets us to today's Wall Street Beat, increased activist activity. He's saying here that 1 in 4 S&P 500 companies have an activist of some type, private or public, and we just saw Starboard build a sizable stake in Kenvue, and Kenvue shares reacting positively to it. Joining us now, Bloomberg's Liana Baker. You think about the amount of shareholder activity that's been going on. You have CVS, now a new CEO announcement off the top of it. Kenvue just spun off from J&J, and now you already have an activist wanting change at the company. What exactly is going on?
So at this point, we haven't confirmed that Starboard is agitating at Kenvue. It's a Wall Street Journal report, but tomorrow the Starboard head is going to speak at an activist conference, and maybe we'll get some more news on that. And Kenvue, it might not be a company you've heard of, but you know the brands. They own Neutrogena, Tylenol, Aveeno, and all these different things. And when it spun off from J&J last year, the stock just, went up the first day, and then it didn't really budge, and it's below where that S&P gains are. And that's why you see, Starboard potentially coming in and pushing for changes.
Let's compare and contrast the different types of activists in this market right now, because we were just talking about activist short sellers, for example, who've had a really rough ride overall with the fact that this market environment has been great for the bulls. What about the backdrop makes this a good market for traditional activists versus those activist short sellers?
So the companies that activists are targeting are already doing a lot of the things that activists like. Spin-offs. Kenvue was a spin-off, and other things, like we looked at CVS before they announced a new CEO, they had thought of a breakup. We don't know what's going on at Pfizer, but these are things that activists push for already. So the fact that companies are doing this means it could be a low-hanging fruit thing to come in as an activist and maybe take credit or not have to do too much heavy lifting to get these companies to do what they want.
So what do you think Starboard may want to do with Kenvue? As you said, they have all these well-known brands, Band-Aids, Tylenol, Zyrtec. What can they do other than sell like the most well-known brands in consumer healthcare? When
you look at a portfolio of so many well-known brands, you have to think, could these brands somehow have more value in a different owner? So maybe spin-offs is something, again, I'm just speculating.
Spinning off
we
a
don't
spin-off?
know.
Maybe J&J wants to buy it.
Divestitures, carve-outs. Private equity, they love these brands that they could, roll up together and be successful. And it really has been a trend for some of these consumer names to just, be sold for, $1 billion for this, $1 billion for that, or more. But it's too early to say what they'll do.
Just a quick observation here. I am so amused by how many of these activists are targeting choppy M&A strategies. Pfizer, nothing good happened there for a while. CVS, pretty much undoing a $70 billion deal, Matt, and it's just stunning to see that spin-offs are now the ones in vogue.
Yeah, I mean, it just goes back and forth. It's a pendulum that swings throughout the years. Liana, thank you so much for joining us. Liana Baker covers deals for us, and she's our Yankees fan, a resident Yankees fan, so congratulations to you on that as well. Coming up in the next hour, we speak to Mina Hawk, the CEO of Tony Roma's. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And it's a countdown to the U.S. elections. Early voting is underway, and Wall Street is positioning for volatility. We're going to look at how hedge funds and the election trade underway.
And we talk inflation and the service industry with the CEO of Tony Roma's. Mina Hawk joins us.
Plus, a new survey shows that private credit continues to be the main focus for LPs deploying capital over the next 12 months. We'll discuss with Goldman's Matt Gibson. But before we get there, let's take a look at these markets right now. Of course, you can see not too much action, but a flip in direction, at least for the big tech index. Your NASDAQ 100 now higher to the tune of about 0.1%. Small moves overall. If you take a look at the S&P 500 too, your big benchmark down about 0.1%, following 6 straight weeks of gains. Meanwhile, that sell-off in the bond market underway. 10-year Treasury yields currently higher by about 6 basis points. Meanwhile, hedge funds are now buying U.S. stocks by the most since December 2023. Let's take a look at how hedge funds are positioning ahead of the elections. We'll do that with Bloomberg's Natalia Knijajevic.
Hi, Kitty. Yes, we see that there was a lot of buying activity last week from hedge funds. This data is from Goldman Sachs Prime Brokerage Desk. 70% of that buying last week came from so-called macro products. These are your ETFs and indexes. That potentially means that hedge funds are not so sure about specific stocks, but they are getting more optimistic about markets on the macro level. So we see that financials, that was one of the biggest buying sectors bought by the most. It's really interesting that that was the 3rd week of buying from hedge funds. Definitely those earnings reports were super helpful for them. And then in terms of size and scope, on a 3-week basis, hedge funds bought financials by the most since February 2021. We also see some buying across utilities, industrials, and then on the opposite side, we see that they keep selling real estate, communication services, and energy. We see that energy stocks are moving higher today, but that wasn't the case for hedge funds last week. Let's flip off the board. I want to zoom in into utilities a little bit. This chart shows that last week, although hedge funds bought utilities, but that move was mainly driven by short covering, and that risk unwind from hedge funds was the largest on record. Again, if we look at data compiled by Goldman Sachs Prime Brokerage Desk, this is basically a signal that you don't want to short those utilities right now. And if we look at specific stocks, like, for example, Vistra, it's up by 240% year to date. It's a huge move, outperforming, of course, stocks like NVIDIA. And finally, let's flip up the board and look at something we are definitely keeping an eye on. This is volatility index around U.S. presidential election. Why it's important? We look at strategies like so-called systematic funds, and they usually take cues from volatility. This chart provided by Bloomberg Intelligence shows days before and days after the U.S. presidential election. We see that spike, which is totally normal as we approach the U.S. presidential election. Now, right after that, it drops significantly. And this is a big signal for systematic funds to increase their exposure. So, Katie, definitely something we should keep an eye on as soon as we approach November 5th.
Yeah. November 5th is the vote, of course, 2 weeks and 1 day from now.
Also your birthday.
But then 3 days later, this is the end of open enrollment here at Bloomberg.
Specifically for Bloomberg.
So if you want to get in your changes,
the clock is ticking.
It's very important. Natalia, thanks so much. Natalia Knijajevic there telling us what hedge funds are buying and selling, and talking about how volatility is going to react surrounding the election. Joining us now is Eric Johnston, Cantor Fitzgerald, head of equity derivatives and cross asset. And I got to ask you really about first the big story of the day, Eric, which is David Kostin, Goldman Sachs, coming out and saying the next decade is going to basically suck compared to not only the last decade, but pretty much every decade, you know, for those of us.
Millennials are Scrooge.
Millennials?
Yes.
Yeah, I mean, you
Also
didn't.
Gen Z,
you didn't really invest through 2000 to 2010, which also was a lost decade for stocks. But what do you think about that? Because Marion Bartels was saying, you know what, everybody says the next decade is going to be lame. And I looked back, Nikolai Tengen, who runs the biggest sovereign wealth fund in Norway, when he took the job, he said the same thing, and we're up like 60% in the last 2 years. So what do you think about the call?
So I'm generally in agreement. We've been, saying that over the next few years, 2, 3, 4 years, that equity returns are going to be fairly poor, especially relative to where rates are, and we expect them to stay relatively elevated, which we can get into.
But the earnings are going to be up 14% in Q4 and in Q3.
So expectations are already very high, so 14% growth next year. But the bigger issue is valuation. And right now, valuation is essentially the second highest we've seen in 150 years, right? Only second to the internet bubble. And we first hit these valuations during the internet bubble in 1998. So for the next 2 years, you actually looked okay, but ultimately those returns over the next 3, 4, 5 years proved to be pretty poor. The other issue you have is that the individual investor has the largest exposure to equities really in history. And they've been really post-COVID, been buying fairly aggressively over the last 4 years. And so that creates another big risk where they're already having this full investment, that's at risk of going down and creating some more supply
households and
in the market.
Yeah.
We've been talking about this for a couple weeks now.
All the time.
Yeah.
That's right. Yes. So that's an issue. And then rates are projected right now, the Fed funds rate to drop to somewhere around 3.5%. We don't think it's going to get that low because we think there's going to be larger inflationary secular issues that are going to keep rates more elevated. And so I think over time, again, that's going to create issue for valuation, but also where allocations goes, right? Where do pension funds allocate in a environment where rates are higher?
Right.
Some of that could move outside of equities to
Man, there's
to
so much
bonds.
to talk about
There
today.
is. I know.
Isn't
I
it
mean,
crazy?
you just made a great,
Yeah.
a series of great points. So basically, valuations are high right now. You have, of course, the American public fully allocated. You have to think where the next catalyst, the next wave of investment is going to come from, and those pensions, endowments, et cetera, might be looking outside the public markets. Let's talk about small caps, though, because I know you came to us with a big call on small caps, and as we mentioned, we talked to Marianne Bartels in the last hour. Here's what she had to say.
In my opinion, small caps are in a secular bear market, the opposite of large cap or mega cap. And again, these cycles can last 15 to 20 years. Now, this doesn't mean that small cap can't go up. I do believe that they can rally, but I don't think they're going to beat the S&P or NASDAQ. In fact, if there was an index that I really wanted to focus on, if my thesis is correct, is the NASDAQ will be the best performing index.
So, of course, a secular bear market in small caps. Looking through your notes, it sounds like you don't necessarily disagree with that, but there's opportunities.
Right. Yes, that's exactly right. You know, from a tactical perspective, into year end, the next 2.5 months, we're very bullish. I think the setup is interesting because small caps are the same price today as they were 3 years ago. And while estimate revisions have been going, sideways or up for the S&P 500, they've actually been going down for the Russell 2000. But the setup for the next 2.5 months, I think, looks super attractive. So you have the election coming up, obviously, 12 days away. And the odds are now moving more in Trump's favor. I think a Trump victory, if it were to happen, people are going to look for what to buy. And I think domestic companies that are more cyclical and will benefit more from deregulation will perform the best as investors look at what to play.
You were talking about interest rates being a part of that, though. I want to pull up something because I want some redemption here. Matt was like, the 5% 10-year is non-consensus, but you pull up the 10-year over 5 days, you're at 4.14. It's
right.
Incredible. And so the direction of travel is not great. And if you pair that with this idea, and I steal this from Torsten Slok over at Apollo, more than 50% of the Russell 2000 is floating rate. You still have sticky interest rates here.
Oh, yeah.
So why does it's incredible. And
by the
that's
way, if
less
we
than a
pull up
fourth
chart
for the
number
S&P.
719 as well, you can just see the share of Russell 2000 companies that lose money is rising. And it's
So,
already almost half.
Under that backdrop, why bet on the Russell 2000 when rates have stayed this high?
Yes. So the biggest headwind is what you're saying around rates, but I think it's going to be overwhelmed with a economic sort of optimism over the next couple months. One of the things, animal spirits, exactly. The other thing is the growth rate, the projected growth rate for the Russell 2000 in 2025 is 32%. Now, I don't think they're going to grow 32%, but as people sort of scour the universe around where am I going to get growth in 2025, right? We know that mega cap growth is slowing down fairly significantly next year. And I think that investors are going to say, okay, small caps, they have more leverage to the upside in the economy and have more leverage because of how they've traded. The other thing I would say is around the election is no matter who wins, we're going to have some perceived certainty, right? So vol should come in, and I think in a perceived lower risk environment, investors are going to say, okay, I'm willing to take a little bit more risk in what I own. And so I think they're going to move on the risk curve, and small cap fits in very well with taking more risk and trying to get some beta into year end.
But only 2 months there.
But only 2 months, because I think ultimately the reality of what your other guest, said, ultimately will come to fruition. And what you're saying right now, around 40 to 50% of the companies not being profitable. And so there are some structural issues that are embedded in those small cap names.
Awesome. Eric, thank you so much for joining us.
Absolutely.
Eric Johnston there of Cantor Fitzgerald. We cover a lot of ground, and there's so much to talk about today because there's so many calls out there, right? The Goldman Sachs call, obviously by David Kostin, but also the T. Rowe Price call of 5%, which again, it is an outlier. You can pair those up with some other calls, right? I mean, for example, Matthew Hornbach of Morgan Stanley says bonds are actually well positioned to withstand a red sweep. So.
Yeah.
A lot
makes the market at the end of the day.
Exactly. A lot of interconnecting circles. And of course, what Eric was saying about this fully allocated investor base, maybe you have to see some of those big giants look outside the public markets. We're going to be talking about that in a little bit. But first, let's take a look at the stocks that are moving in the public markets. We'll do that with Abigail Doolittle.
One stock that's really popping sharply higher, Lumen Technologies, up more than 6%. This after they announced a partnership with Meta to help Meta expand their AI network. AI still hot, clearly helping the shares of Lumen today. Turning to Kenvue, these shares are also higher, up more than 6%. 6.6% at this point. Starboard Value has added what the Wall Street Journal is calling a sizable position. We don't know the exact size of it, but they're well known for trying to help gain more value out of shares. So investors seem to be encouraged by this. It's the best day since early August. And then finally, one stock higher, one stock lower. The shares of Humana are popping. The shares of Cigna are lower. There is talk that these two companies have reignited their potential merger news talk discussions, and that the election could weigh. Mizuho is saying it's not a matter of when, it's a matter of, or it's not a matter of if, it's a matter of when. Just the timing is the key piece.
Abby, we thank you so much for looking under the hood. And coming up next, we're going to talk about public and private. We're going to look at how private assets are doing compared to the public markets. We're going to be joined by Matt Gibson of Goldman Sachs Asset Management, now a unit with more than $3 trillion in assets. This is Bloomberg. Now, Goldman Sachs said in recent days that expects to raise more than $60 billion in funds to put towards alternative assets. That's a 20% rise in its fundraising goal. Goldman also spoke to almost 240 investors in private markets from around the world, and private credit is the biggest area of focus for those investors. And joining us now, Matt Gibson, Global Head of Goldman Sachs' Client Business, Asset and Wealth Management Division. Of course, this is a fast-growing division over at Goldman, but want to pull up a chart here of what your clients are most concerned about in this market. Most people are concerned about geopolitics, valuations. This is over and over public and private markets been a big issue here. Less so recession and interest rates from a year ago. How are they navigating some of these things, particularly geopolitics, that they don't have control over?
Well, thanks for having me back, Sonali. It's exactly like you said. When we took the survey a year ago, inflation, recession, interest rates, biggest concerns that clients had. 12 months later, huge shift. Geopolitics, equity valuations. I'd add elections to that as well. Look, I think our clients are taking a couple approaches. Number one is just to continue allocating. 80% of the survey respondents said that they intended to allocate as much or more to alternatives in 2025 as they did in 2024. So despite all the uncertainty, they're not slowing down. I will say clients are being a little bit more cautious, particularly on the public side, right around the election. And they're basically in a little bit of a neutral policy from a risk perspective because it's unclear who's going to win right now. And there's very different outcomes between the two. And so I think privates keep investing, publics be cautious right now.
And let's talk about a few of the other takeaways in this survey. I thought it was interesting that many investors think that they're under-allocated to private credit. Two-part question here. What type of investors did you speak to for this and survey for this? And what areas in private credit do they want to get more into?
So really good question. We had 235 clients respond. 80% were LPs, 20% were GPs. It was global in nature, and it was institutionally focused in terms of who the clients were that we talked to. And the takeaway was what you said, private equity and real estate over-allocated, private credit, infrastructure, and secondaries under-allocated. And when you think about where clients want to get to from a private credit perspective, despite the fact we've been doing it for a long time, it's still relatively new relative to the others. And so some of the new areas of private credit would be asset finance, for example, that's growing very quickly. There's all sorts of strategies from mezzanine to direct lending to hybrid solutions. And we're seeing clients have interest in all of those strategies depending on what their risk return profile is. And so I think it's not one specific strategy in private credit, but it's really all of them depending on where they want to go.
What are the interest rate expectations or the changing interest rate expectations mean for that result? Because at this point, I feel like private credit's the only thing we've been talking about for the last 2 years.
Right.
A lot of companies are maybe having trouble making the payments, right, as interest rates went higher. And so we were hoping for some relief as interest rates come down. And now we're back to worrying about fewer cuts than the Fed has promised us to begin with.
Right. It's a great question, Matt. I mean, in 22, 23, you had a great investing environment for private credit. And you were able to earn returns that we hadn't seen for quite some time. As you mentioned, rates have come off. And so, the spreads have come down a little bit in terms of what you can earn for the same loan versus a year and a half ago.
Spreads must be at all-time private credit tights. Right?
Yeah, they're tight right now. But we're still seeing, I'll tell you, we're still seeing investment opportunities that are quite attractive for us out there. There's a lot of deals that we're seeing, come across our desk. And we think there's going to be a lot of growth there still. I mean, there's a lot of innovation of all the asset classes. You're probably seeing the most innovation in private credit of all of them. And again, this asset finance business that I mentioned before is something that keeps sort of innovating and something that we're investing a lot of time in. We expect to be a big business for us.
Let's talk about shapes and forms of private credit for a minute here. Of course, Katie and I have been following a lot this idea of the ETF in private markets, investing in private credit, and among other things. But then there's also interval funds. There are these semi-liquid vehicles. How much do investors really want to get into private assets, which are illiquid by and large, into ways that are more liquid? Is there not a mismatch there?
Well, it depends on the type of client. And, you've seen a lot of growth in the last, call it 10 years, in retail-oriented vehicles for retail clients. And we spend a lot of time structuring those so that they, to your point, meet the liquidity requirements of the retail investor. And so, ourselves, we have a full suite of those vehicles out there for retail clients. And, on the credit side, which we've been talking about quite a bit, we expect those to scale pretty rapidly here in the coming years. But liquidity and structuring is always a big part of that because you have to make sure institutional clients have one set of things that they will accept. When you start talking about retail clients, it's a very different discussion.
They want their money back at some point.
They want liquidity. Everybody wants liquidity, it turns out. But the retail investors are incrementally focused on that, and so you have to structure for that.
There's 5 different things I could ask you. I picked one, though, and I want to talk about the competitive landscape. Of course, you just raised your fundraising target. It feels like everyone is raising massive amounts of money in the private credit space, but what are the deployment opportunities? I mean, what does the pie that you all are fighting over actually look like here?
Yeah, so it's very competitive out there, to your point. One of the things that we think is an advantage for us that I haven't talked about yet today is we actually have our private credit business housed within Goldman Sachs, and it sits right next to our investment bank. And so when you think about how we source and originate transactions, it's our asset management team on the investing side that's doing that, but it's also our investment banking team of 3,000 investment bankers out there every day. What you find is sitting side by side with the same culture, same set of incentives, playing on the same team, our private credit team often finds themselves in situations that are idiosyncratic to Goldman Sachs, can see loans early before others see them. So the funnel that we invest is more attractive, we believe, than others. And so we're seeing a lot of options out there right now.
Matt, we only have about a minute left here, but want to know about the growth opportunities you're seeing because you saw Perplexity over the weekend. The news that it may triple its valuation in private rounds. Goldman has been genius at these types of structures early on for their high net worth clients. Are there a lot of those coming through the pipeline into next year?
In terms of?
Growth equity.
Oh, sure. From a growth equity perspective, I mean, we ourselves have a fund that we will be launching in 2026 that we're quite excited about. Growth has been a little bit on the sidelines now for a few years. Now, since you saw elevated valuations in 2021, fell off in 2022, 2023, and 2024. The IPO market has been slow. And so, we believe that the market for growth equity is going to pick up again in 2025. And, we intend to be a big part of it.
All right, that's a good place to leave it. Really appreciate you coming by the studios. That, of course, is Matt Gibson of Goldman Sachs Asset Management. This is Bloomberg. Thank you.
Thanks.
All right, let's get a check on these markets. An hour into the U.S. trading day, volume is light and the moves are small. The S&P 500 currently down about 0.1%. You take a look at the big tech index, your NASDAQ 100 higher by about 0.1%. So small overall after this big rip-roaring rally that we've seen over the past couple of weeks. The bond market, meanwhile, you are seeing some action there. 10-year yields higher almost by 7 basis points. Now coming up, Tony Roma's wants to be a 52-year-old startup. CEO Mina Hawk joins us next. This is Bloomberg. Well, Tony Roma's is getting a refresh. The 52-year-old restaurant chain is undergoing a transformation under its first female CEO. I am thrilled to say she joins us on set now. Mina Hawk, Tony Roma's CEO. Great to see you in person.
Thank you. Thank you for having me here today.
Yeah, absolutely. So the tease for this block was that you want to be a 52-year-old startup. Walk us through what that means.
So Tony Roma's has been around for a long time, since 1972. It opened its door in Miami, Florida. The company went through, what I like to say is all types of challenges, but nevertheless, it has been a resilient brand. And now what I'm doing is reimagining the brand to see how we can make it resilient and adaptable. And the core focus is on our product, on our menu. The food industry is the fastest evolving industry with consumer demands always changing. Therefore, you need to keep up with the technology. You need to see how you can do co-creation of partnership. And that's what I'm doing. And most importantly, internally, focusing on my talent development.
We're going to want to talk more about that menu and, of course, the technology, but also want to know about locations. Because you sat down and you said you're going to change that. When we asked you about the locations, the closest one to New York City, you said is Durham,
That's
North
correct.
Carolina. How are you going to expand in different areas in the United States?
Absolutely. It's about, creating the value for consumers. At this point, we have about 10 locations in the United States, all dispersed. We have the nearest location is North Carolina from here, but we have 2 locations in California, in Vegas, in Iowa, and Florida. I see that we will be able to change once the consumers will be able to see the value that we offer. And most importantly, our primary business model is franchising. What I'm trying to do is reducing the franchising cost, making it easier for potential franchisees to enter into the market. Otherwise, in any type of franchising industry, it's very difficult because it's so cost heavy. Therefore, if you can reduce the operating cost, in addition to that, the menus items were very saturated back in the days. We used to offer a lot of items. I'm streamlining that as well, making sure it's cost effective.
I mean, the food obviously is first and foremost in a restaurant, but I feel like talent comes in a close second. And you said, talent development is one of your biggest focuses. How difficult is it in today's labor market? Because you've got to pay people a lot.
That is a great question. We are working remotely at this point, which is attractive for the talent pool because everyone wants flexibility. And that is one of my core focus. How can we strike a balance by being flexible, yet ensure that the performance is there? And that requires boosting the morale of your team. And part of the reason I believe is because of the advent of technology, people no longer want to come and work in the industry anymore. People embrace entrepreneurial spirit, especially young folks think, okay, we can go to TikTok or Instagram and create our own career, which is absolutely fine. But I want Tony Roma's to be a stepping stone, a place where people can come, learn, and thrive.
Interesting, of course. So using that remote work as a recruiting tool, basically. I do want to talk a little bit about pricing because you mentioned creating value for customers. And we were just talking about high labor expenses. I mean, you think about the consumer, the people who are spending money at your restaurant, definitely feeling the pinch there. So how are you handling pricing right now? Have you had to cut costs, of course, as things get more competitive?
Yeah. The review for pricing, it's based on a 360-degree review. What we have figured out is you focus on the stars of your menu, and then the items that are doing well, offer that back to your consumers because the food price is skyrocketing right now. And it also depends like how many locations you have, and we definitely don't have as many locations as our competitors, so we don't have that many buying power. Nevertheless, our core focus is to make sure that it is price friendly because traditionally Tony Roma's has served families, and there are so many memories that are associated with the brand. Right now, we are in control of pricing for our corporate unit location, which is Bones and Burgers in Tampa, Florida. And then the rest of the location we have, the pricing is determined by the local market condition by our franchise partners.
Mina, great having you in the studio. Thanks so much for visiting us here in New York. Mohamina Haq is the CEO of Tony Roma's. Let's get a check now on what's going on in this market. An hour and 4 minutes into the session with Abigail Doolittle. Abby?
Well, after 6 up weeks in a row for the S&P 500, we're looking at a small decline right now, down about 0.2% on well below average volume, though about 20% below the 20-day average. So a lot of traders not engaged on this Monday. Where they're more engaged, crude oil, although it's off of its highs, up 1.3%, earlier up 2%. Some of this having to do with the Middle East conflict. The 10-year yield, T. Rowe Price out with that call that the 10-year yield will be back above 5% within 6 months. Well, investors seem to be hearing it, up 7 basis points today at a 415. And then that is helping the Bloomberg Dollar Index up 0.3%. It's sort of interesting that oil is climbing even with that dollar strength. As for the S&P 500 and this area of gains that we've been in, because again, that's just a small decline for the S&P 500 early in the week. Here are those 6 up weeks in a row, and that is the longest winning streak of the year. It's the longest winning streak going back to actually, it appears, yes, last December and November. So again, a small decline right now, but perhaps that will be paired. And then a big driver for stocks this week is going to be earnings. This week, we have $8 trillion worth of market cap and companies reporting. Next week is, importantly, Boeing and Tesla and UPS. Next week, though, that's the big one. Nearly $24 trillion worth of market cap in companies reporting, including Apple, Microsoft, all of the big tech companies, really. And then we kind of peter out. But as we've been talking about, it always feels like it is earnings season.
Well, and by the way, analysts continue to sneak in lower estimates, right, Abby?
Where'd you get that from?
We were, you know where I got that
Data
from.
Trek.
Data Trek. Yeah, we were expecting 4% and change earnings growth, and now it's like 3 and change, even less than 3.5, I think, right now.
Well, that's a great game of management's teams managing expectations. I think ever since that 2000 tech bubble, when there was quarter after quarter where they could never meet, they finally learned to set them low, and then analysts kind of playing that game along the way.
Abigail, thanks very much. Abigail Doolittle looking at the stock market for us. Netflix on Friday hit an all-time high. The shares today are off a little bit, but it doesn't mean much when you look at it over the last 3 years or 5 years or 10 years. Last week, we asked the CEO of Mountain, Mark Douglas, about that growth in streaming.
Advertising is just a start in monetization. I think you're going to see, shopping directly off shows and things like that coming in the future. It's still a few years out, but the biggest streamers are going to have, or you're going to see them go beyond advertising itself. So it's it's kind of a big transition period we're in right now. So
his, the main headline, the takeaway, which I didn't hear in that soundbite, is that Netflix is going to be the first $1 trillion entertainment company.
It's a big call.
It's a huge call.
You have to triple from here.
Exactly. Yeah. And we've already quadrupled from the bottom in 2022, which we were talking about last week. So he's making this big call. You saw on the Motley Fool, they came out and kind of made a similar call after he did. But they said over the next decade. And he says, no. It's going to happen much faster than that because there's so many different drivers.
All right, so a huge bull there. Like Sonali mentioned, the market cap would have to triple, currently at $326 billion. But you think about their dominance in streaming, of course, reporting earnings last week, knocking it out of the park. And Bloomberg Intelligence says actually they're being a little bit cautious. When you take a look at their margin guidance in particular, it could hit 30% on margins in 2025. So the stars aligning for Netflix. It's not surprising to see some big voices coming out in support.
You have to wonder if there's more room to invest at that rate, because you have them selectively investing in big ticket items like the NFL, selective games, but you can't get a whole lot of ad revenue based on one-off games, can you? They have to spend more to get there. But again, just from what you saw in the last earnings report, the Rise added about $32 billion in market cap that day alone on Friday. So you could see them growing pretty quickly from here every time they have that upside beat.
Well, you think about their international expansion as well. I mean, they're really making inroads around the world. But of course, we were talking to someone about how that's maybe not as attractive to advertisers at this point, but it could change.
Well, and I mean, Mark runs Mountain. That's an ad server technology platform. And so that's what he's focused in on Netflix. It's not whether they have a couple of NFL games on Christmas Day or if they start, giving consumers video games. It's how much they can serve ads to specific people watching things.
Would you play games with ads?
No. No. But I'm not in the beginning tier of Netflix, right? I'm not going to drop down there because I just can't watch unless the ads were really focused on me. If I saw ads for like a Grateful Dead shirt or a Ducati, then yes, then I would take the ad tier.
All right, well, someone somewhere is listening, and it's going to create that ad for you. But in any case, Netflix shares up 56% year to date. Now, coming up, the case for nearshoring. Shannon O'Neill of the Council on Foreign Relations looks at U.S.-Mexico trade in today's Wall Street Week. This is Bloomberg. And it's time now for our daily Wall Street Week conversation. And supply chain disruptions during the pandemic showed that relying on China for goods is not sustainable, and that the U.S. needs to focus on trade with countries closer to home. David Weston spoke with Counsel on Foreign Relations Senior Vice President Shannon O'Neill about the benefits and the risks of nearshoring to Mexico.
We have seen a huge move of capital around the world, and especially as supply chains and production moves out of China, it has spread all around the world. And Mexico has been one of the biggest beneficiaries. Over the last couple of years, we've seen $36 billion pouring into that country in foreign direct investment. The government hopes for much more as we go forward. So you really have seen a change. That said, many other countries are benefiting as much, if not more, from the movement out of China as Mexico. And part of Mexico's challenges are self-made. It's its own barriers that it's putting in front. So it's things like not having access to affordable, consistent, clean energy. It is ongoing insecurity challenges across the country and the cost of doing business when you have to protect your factories, your workers, your goods as they transport to the United States up to the border. And it is the political uncertainty that's been introduced into the business climate, both in terms of getting permits and licenses, and more recently in terms of the justice system and whether the business playing field is still as level as it once was.
There's been talk about the attraction of Mexico as a place to invest and to ship goods in the United States for a long time. People talk about a Mexico moment that never seems to quite get here. Have they made progress in Mexico at addressing some of those barriers you just identified?
You know, Mexico over the last 30 years has become one of the most important trading partners of the United States. It's always been in the top 3 over these last 30 years. And in the last couple of years, it's become the #1 trading partner for the United States, and particularly a place where we get imports from, replacing in many ways China. So it is a vital part of the North American ecosystem of production. We also see Mexico is not just shipping commodities, things like oil or agriculture or the like, but really advanced manufacturing goods. And it works with the United States, with U.S. companies to create very competitive cars and machinery and planes and all kinds of other things. So it is incredibly important, and it's become bigger and more important for the United States as we go forward. But that is often in spite of many of these things that have been put in place in Mexico's economy, many of the access to energy, insecurity in the economy, the business environment overall. And that actually has gotten worse over the last 6 years, not better.
In the wake of the pandemic, we heard so much about redoing supply chains, making them more resilient. U.S. companies were going to do this through Mexico and elsewhere. Is that as easy to do as we make it out to be sometimes?
It's very hard to move supply chains. And just to give you a couple pieces of data that go to it, if you look over the last 30 years, this is the years of the rise of China, of outsourcing, of globalization and hyperglobalization. Each year, just between 1% and 2% of supply chains cross borders. And that shows you how even in these big global trends, supply chains are much stickier than one would think. And in part because if you find somebody who can produce the part or the component that you need and deliver to you high quality on Tuesday morning, you're not going to look for someone else unless you really have to. Now, in the last few years with the pandemic, with the US-China competition and the like, we've started to see more movement than that, much more fluidity in supply chains.
And that was Shannon O'Neill of the Council on Foreign Relations. And Wall Street Week host David Weston joins us now, sitting to my left. And it was a really interesting topic of conversation that we talk about Mexico all the time and the concept of nearshoring. But there's many other countries that have benefited just as much as Mexico from this movement out of China.
That's exactly why we did this story, because we actually went down to Mexico to see for ourselves how much of it is real, because we keep hearing about this nearshoring. And there is, to be sure, a growth. In fact, it's just happened in the last couple of years that now Mexico is a bigger exporter of the United States than China is. So it's past China. At the same time, it's not as dramatic as you might have thought. There are other countries like Vietnam, countries in Asia, who also ramped up substantially. And as you heard there from Shannon O'Neill, part of it is because Mexico has some problems that it needs to address with the new Claudia Sheinbaum administration. We'll see if it happens.
Part of Donald Trump's stump speech is that the Chinese will see these tariffs and sneak into Mexico to try and sell us stuff over the southern border. He wants to obviously to stop that. He says he's going to put 200% tariffs or never let them sell stuff from Mexico. But they've already done it in some senses, haven't they?
Well, they haven't. One of the places we've visited down there in Saltillo, which is outside of Monterrey, actually is a company that says it's Singapore because they changed their headquarters from China to Singapore in the last 3 or 4 years. But it's been manufacturing plastic goods in China for some time, and now they have a substantial plant. They're building a second one right down there in Saltillo for just the reason you described, to export into the U.S. market. At the same time, it did strike me that former President Trump overlooked his USMCA that he negotiated that requires 70% of the value of automobiles imported from Mexico be created in North America. He did that, so it's a little hard for China simply to move in and ship cars into the United States.
So what does this all mean if you take it all together for the nearshoring efforts for the U.S.?
The question is really for investors, is this a good investment to make? We first got onto this story because somebody from KKR was saying this is where you want to go for commercial real estate. It's a bunch of warehouses just south of the border. And there is a lot of development going on down there, a lot of investment pouring in. The question is, how big can it get? And to come back, to some extent, that depends on the Mexican government and what they do. I mean, whether they address the political insecurity, big energy challenges, and typically down there that really has to be a state-run thing, energy, as you know. And also, there's still security issues about protecting your employees. There's still issues down there. So the question is for this new administration, can they overcome that to really make it attractive for U.S. investors?
Well, timely conversation, of course, with just 15 days until the U.S. presidential election. David Weston, great to see you. And, of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
We are about 2 weeks to Election Day here in the U.S. Kamala Harris is hitting 3 states today: Pennsylvania, Michigan, and Wisconsin. Donald Trump will be focusing on locking down votes of young men, black men, Latinos. Joining us now is Bloomberg Balance of Power co-anchor Kayleigh Lines. Kayleigh, what should we focus on in the next 2 weeks? It doesn't seem like there could be many undecided voters left, right? So it's all about getting the vote out.
Yeah, absolutely, Matt. This is a turnout game at this point with 15 days to go until Election Day, keeping in mind that the election already is well underway. Early voting is already happening, including in a number of critical swing states. North Carolina and Georgia both have each had more than 1 million voters vote early at this point. They're setting records for turnout, so that's something to keep an eye on. But yeah, it really is about making sure that the base of these candidates is galvanized and ready to go to the polls. Yes, that basket of undecided voters at this point ready to claim for either candidate is quite small. You're still going to see the efforts at reaching out to those people who may not yet be in Harris or Trump's camp. You're seeing that today as Kamala Harris is focusing on the blue wall Rust Belt states of Wisconsin, Michigan, and Pennsylvania, and doing so with former Republican Congresswoman Liz Cheney, the daughter of former Vice President Dick Cheney, part of an effort to reach out to more moderate Republicans to bring along on her side. And Donald Trump, as you mentioned, Matt, really focusing on men in particular as we see this incredibly wide gender gap in this election. It does not seem with 15 days to go that will change very much.
Can we talk about also the motivation? Because some people are motivated by the future of this country. Some people might be motivated by money. And I want to hone in on Pennsylvania, this idea that Elon Musk could give money to registered voters. You have Governor Shapiro talking about how that could be deeply concerning. Talk about the rhetoric behind what might come from all this.
Yeah, well, what you're referring to, Sonali, is Elon Musk saying he will pay out $1 million each day between now and November 5th, Election Day, to a voter in a sweepstakes. This is where it gets a little fuzzy, because what essentially he is giving out $1 million for signing is a petition regarding the Constitution, supporting the right to free speech and the right to bear arms. You do have to be a registered voter, though, to sign that petition, and that's where it gets legally very murky, because federal election law does say you cannot pay anyone to register to vote or to vote. And because this is closed to only people who are registered to vote, not open to the general population, that's where some election law experts are saying there could be room for a potential legal challenge here. Certainly, Governor Josh Shapiro of Pennsylvania said he would like law enforcement to be looking into this. But of course, that's not a fight that's likely to be resolved between now and Election Day.
Yeah, a lot of question marks over that one. And like you said, quite a drawn out timeline for figuring it out. Let's talk about the state of polling, though, as we head into the final 15 days here. We were just showing a chart, of course, about key swing state polling, what the Electoral College might look like. And public polls, too, have indicated some backsliding for Harris in those key states as well. I mean, what is the state of play right now?
The state of play, Katie, is that this is a neck-and-neck race. Basically, any poll we're looking at is well within the margin of error, whether it is on the national level or in the polls of these crucial battleground states that will decide the balance of the Electoral College. So at this point, no one I am speaking with is confidently telling me they are able to call this race at this point. Certainly, financial markets are seeming to indicate that they are more confident in a Trump victory, as we have seen this leveling out or this tightening of polls in many ways. But the fact remains right now that this race is still too close to call, which is why turnout is going to be so important. If we're talking margins of just tens of thousands of votes in a handful of states, those tens of thousands of votes that show up are going to matter very much. Again, we're only working with a 15-day window here to change any minds that aren't already made up.
All right, Kaylee Lyons, a busy 15 days coming up for you. Really appreciate your reporting on this Monday.
Do you know that I listen to her show every single day?
I believe it.
Joe Matthews starting at noon on Bloomberg Radio, then
True.
Kaylee and Joe at 1 o'clock to 2, and then they come back to reprise the program at 5 p.m. every day on Bloomberg Radio and television.
Committed to the cause of bringing you the latest, of course, as we count down 15 days until the presidential election. Let's get a check on these markets, of course. You can see that we've turned decisively lower in the S&P 500, currently down about 0.4% near those session lows. The big tech index, your NASDAQ 100, down about 0.3%. That bond market sell-off accelerating. Coming up tomorrow on Open Interest, we'll speak to the CEO of Okta. This is Bloomberg.